All right, welcome to our free course on how to build a three-statement model. This is also called a financial statement model. This type of model is really the foundation of a lot of modeling that you'll do as a corporate finance analyst, an investment banker, private equity associate. What's great about this is that it forces you to understand how the three financial statements all interact. It really is as much an accounting course as it is a modeling course. The purpose of this course is, rather than doing what we do in our full-scale financial statement modeling course, which is to build a full-blown real company, and it takes a long time, and we filter through a whole bunch of financial reports and go through all the nuances. Here, we're going to make this really simple. We're going to break down what is the architecture of a three-statement model, so that at the end of this course, you're going to understand the core architecture that applies to just about every company of how you build a financial statement model. So we're going to get started. The purpose of this is to show you how to do this from a blank Excel screen. And we're going to move fairly quickly along this, so follow along. My recommendation is you open up an Excel file from scratch, just like this one, and try to recreate these steps. Hit the pause button whenever you're ready to recreate the steps on your own. So let's get into it. So let's say the last actual year is 2023. So I'm going to sort of put this here, and then we're going to usually model 3 prior years. You can also do quarterlies. It's the same idea. We're going to do an annual, and then you've got let's say 5 years of forecast, right? So this is sort of a typical thing where you've got forecasts or projections for 3 to 5 year period. So we're going to do that here, and I'm going to do a center across selection. Control 1 opens up the format dialog cell, and I do a center across selection. I never want to do merge cells because, as those of you who taken our Excel course know, this is a best practice. That way, you can grab columns and things like that. And so here we've got our actuals. We're going to do the same thing across here. Control 1, go in to text alignment center across selection. We hit OK. And now we're good to go. So again, these are our actuals. These are our forecasts. And now the very first line that I'm going to put in, first of all, I'm going to, for my sort of dummy numbers, I'm going to say the dollars are all in millions, right? So let's say this is a company that generates revenue, and I'm going to sort of use this column as, I'm going to start with the income statement. I'm going to use this column to sort of line out, put out my line items. So let's actually label this income statement. And I'm going to make sure there's enough room here all around. I'm going to have to keep spreading this. In fact, since I'm going to have to keep spreading this, Alt OCW, let's make the width sort of wide enough where I don't have to keep hitting that button. So I got revenue, and the typical line items, they might be different from company to company, but you're going to typically see something like cost of goods sold. Then you're going to see other operating expenses. And then you're going to see something like, operating profit. So this is kind of that first. So I'm building out what you typically see as an income statement. I just highlighted, I wanted a little bit of room here. And then below operating profit, what you'll typically see is interest income. You'll typically see interest expense. And then you're going to see something like earnings before, or let's be consistent, operating, or let's call it profit, right? Pre-tax profit. That's probably the most consistent way to describe this. And then we have our tax expense. And then we have our net income. So this is a very typical condensed income statement that you're going to see, and we're going to just put in some dummy numbers in here. Hi, everyone. I hope you're all enjoying this free financial modeling course. I wanted to interrupt for just 1 minute and talk about Wall Street Prep, the company that has created this course, and talk about all the other courses that are offered through this platform. So on wallstreetprep.com, our website, you're going to learn all about what we offer, from self-study courses to live boot camps. Our focus has always been on those technical skills. And the way you're going through this course now, that's kind of the philosophy. Keep it simple. Start as much as possible from a blank Excel screen and walk through the work just like you would on the job. Now, the difference between what you're going through now and the courses that some of the most prestigious companies all over the world, from investment banks to private equity firms, again, Fortune 500 companies, what they bring us on to do and what we productize and package in self-study programs that we make available to you all as individuals, and you can see them all here. Our philosophy around that is making it simple, step by step, demystify all the jargon that you hear. And so if you think about this course, the one you're going through now, this free financial modeling course, as the foundation for all of this, our full modeling certification courses are the ones that take you to the next level. Our most popular course, and I'll just highlight one because there's just too many here to highlight, but the one that sort of picks up where this course leaves off is a course called the Premium Package. Basically, this course is what put us on the map. We started this company about 20 years ago. And the idea at that point is to take what's taught in investment banks, to take what's taught at private equity firms, and to make it widely accessible in the simplest way possible to people who want to consume it, either to break in or perhaps they don't have access to formal large training programs on the job. That's what this course is about. Same style, same approach. You're going to learn the core financial and valuation modeling skill set. And really, this course is about 6 courses in one. It's really a full-blown version of what we're going through now, the real deal. And the goal is to have you really just get the knowledge that you would if you had spent a year in investment banking. And so with that, I'm going to stop the plug and I'm going to let you get back to this course. We're going to just put in some dummy numbers in here. So let's say we have, 100 in the first year, and then you have 1,100. Cost of goods sold, let's say, is 80. Again, this is a purely fictional company, and so I'm just kind of making up numbers here as I go. And, maybe actually let's change this so that it's not, so that gross profits are actually a little bit higher. We don't want to have no profits for this hypothetical, just so we have enough to play with. And let's say operating expenses are going to be 150, 165, 175. And notice here, the way I've structured this is I've put these numbers as positives, although they are expenses. That's typically how you see companies organize. So you typically see companies organize their financial statements where the operating expenses are presented as negatives. Just as a reminder, cost of goods sold, these are direct costs of manufacturing something. So if this is Apple, cost of goods sold would be the cost of actually procuring the inventories, producing the iPhones, etc. And then operating expenses is your sales folks, your engineers, and a whole bunch of other stuff that's just required. Administrative expenses, anything required to keep the lights on. And obviously different companies are going to have different sort of levels of this relative to their revenue. Getting back to the point here about plus and minus signs, most of the time you're going to leave this as plus. Actually, in our course, in our full-blown financial modeling course, we actually do advocate switching this so that it's really clear that these are expenses. So maybe to be consistent with that, I'm going to go ahead and do that. One simple way to sort of automatically turn your numbers negative is to use Paste Special. I'm going to put -1 off to the side, and I'm going to paste special Alt-ES multiply. This is a trick to turn your numbers negative. I actually didn't want to do that here, so let me undo that for the revenue. And now very quickly, I've got all my expenses as negative, and my operating profit now is simply a sum function, which is Alt plus sign. And that way, I've got all my information. This way I can delete the sum. And the other thing that's kind of an eyesore here is I like my numbers formatted in a certain way. I specifically don't like, when you're building financial models, you don't like your numbers to have negative signs. You want them to look like they have parentheses. That's considered a better structure. And let's put 1 decimal place. That's also a good structure. And let's just go down here and make these, comma separated with parentheses. This is kind of considered more accurate and more in line with formatting best practices. Again, we spent a lot of time talking about this in our full-blown course. Here, I just want the basic idea so that you can move on. So here we have it. And then for interest income, historically, let's say the company had about 60 million of interest income. Perhaps they have a lot of cash on their books that's generating some nice interest income. Maybe that's too much. Let's do 5, 6, and 7. In interest expense, let's say they've got some debt, and that debt is generating historical interest expense as well. Now, again, we're going to want to turn this negative, so let's put that -1 off to the side. Again, I want to make sure that we're consistent where all expenses are negative, and then I'm going to format it consistently. And now again, because I'm formatting expenses as a negative, this isn't always the case, right? And if it's not the case when you're encountering models like this, you just have to make sure that your subtotals, like pre-tax profit, sort of does the subtraction. So the key is consistency. I like keeping all expenses as negative because it just keeps it simple and consistent. So now I've got operating profit plus my interest income, minus the expense, but here all I have to do is do a plus, and I can actually do this kind of like this. And, if I didn't have this here, I'd feel better about that, then I'm just kind of doing it like that. Otherwise, I probably prefer, just to avoid accidentally grabbing a row that I didn't mean to if I ever put anything in row 10, maybe this is the best way to get this set up, something like this. So now I think we're in good shape. We're ready to go. We've got our tax expense. Let's say taxes for the year were 70 historically. And again, usually for the historical data, you're going to be able to get, the company is going to provide you with this data. So we're hard coding it. Typically historical data, you're going to see hard coded, right? Let's get that here. And again, this is a negative. So let's flip the sign. And I'm going to copy paste formats, right? I want that sort of nice formatting for negative numbers. And again, now I've got myself down to net income as this sort of pre-tax profit plus tax expense. So now, the last thing that I actually like to do is hard-coded numbers generally really should be presented as blue cells. So I'm going to go ahead and do that here. So I'm going to hit Alt-C, invoke sort of the color here, and I'm going to find the color that I like the most, my sort of favorite blue color here. Those of you, I didn't necessarily want to do that because now I'm getting the formulas. Those of you who use add-in tools that automate this, you could use that. But let me show you a trick to avoid, coloring blue cells, coloring formulas blue, right? So how can I in one fell swoop do that? I'm going to hit something. This is if you don't have an add-in toolkit like Macabacus or Capital IQ or FactSet, which kind of automate the formatting process, there's a trick to doing this. You go to special, which is, you hit F5, and then you click on that special right here, Alt-S. And then you click on identify all constants. So this is kind of a pro tip here. And actually, let's make sure that we're only highlighting numbers. And what you'll see is it highlights all the hard-coded numbers. And now I can go and format those, that blue that I really like, this blue right here again. Those of you who on the job will get access to add-ins, will make this a lot easier. You can just in one fell swoop invoke a keystroke and it works. But this isn't that bad either. And I've formatted all my hard-coded cells blue, which I like. And now it's time for me to start thinking about projections. So if this is the company, the historical data that I've laid out for a simple business, I want to build a 3-statement model. I want to figure out what does this company's forecast look like? Well, so the very first thing I want to do is right below here, and I'm going to actually zoom out a little bit so you can see this a little bit easier. And I'm going to put some metrics down below, right? Margins, growth rates. This is where you can sort of analyze how the company is doing historically, and that tends to be a good guide in terms of the future for the company. Gross profit margin, operating expense as percent of sales. Right, these are the kinds of metrics, and let me widen this out. They're going to help us really think about what the right way to forecast is. So down below, revenue growth rate. Historically, how has the revenues for this business grown? And the way I do that is I take the current year divided by the last year minus 1, and I get a growth rate of 9% historically. Now, I can't really do it this year because I can only get 2 years worth of growth rate. So this is kind of a typical issue. And what this is telling me, and let me actually increase the decimal place a little bit. I like my growth rates to have one more decimal place, and I want to keep that consistent. So what that's telling me is this company historically is growing at, 10, 9%. Again, the rubber meets the road in terms of modeling when it comes to making good assumptions. Now here, this is a simple exercise. This is a purely hypothetical company. So let's just take the sort of average of the last 2 years growth rate. And let's use that. Let's use that as kind of what the growth rate is going to be going forward. And in fact, I'm going to just do this. And so let's say it's going to be 9.5% every year going forward. And you could have hard-coded this for the purposes of this exercise. I wanted you to see that sometimes you can also anchor it relative to the historical performance. You could have made it relative to this year. There's no right or wrong. It's just you have to analyze the company that you're dealing with to really figure out what the right growth rates are. But obviously, that's what's going to determine the fidelity of your model. All right, so now if we said this company is going to grow at that rate, well, now in order to grow, what does that mean in terms of what we think 2024 is going to look like? This is the simple formula that gets you there. Last year's revenue times 1 plus the revenue growth rate. You copy and paste that across. Again, you want to format this. Now, this time you want to format it not with a blue cell, right? You want to format this as a calculation. So you just want to get that formatting consistent where it's, positive numbers have 1 decimal place, etc. So the first part is done. Now we have another line. I want to be able to frame cost of goods sold going forward. Really, the most common way to do that is to look at gross profit margins and say, okay, well, if I have revenue and I have cost of goods sold, I can actually calculate my gross profit margin, right? And gross profit margin, for those that don't know, is simply the reverse of your cost of goods sold as a percentage of revenue. So if I take my cost of goods sold as a percentage of revenue, divide those two and look at that historically, and what that tells me is, okay, well, this business, for every dollar that it earns, 65 cents has to go towards direct costs of manufacturing or procuring the product that this company is selling. Well, that means the profit margin, first of all, I'm going to flip the sign here, can be arrived at quite simply by taking 1 plus this amount, 35%. And the reason why it's 1 plus and not 1 minus is because the number here, the way we've presented expenses is as a negative. So 1 plus, this 65% gets you to the gross profit margin. And now I'm going to do the exact same thing here for projection. I'm going to say, well, let's assume that the gross profit margin is going to stay the same. And I'm just going to sort of link that to the first forecast year as sort of the average. And now I kind of have to do some reverse acrobatics to get to the implied cost of goods sold, but it's not that hard to do. If you really think about it, if you have an expectation the gross profit margin is going to be 37%, well then I'm just going to take 1, I'm sort of going back, right? I'm going back, 1 minus that 37% is going to give me that sort of direct expense margin. I'm going to multiply it by the revenue. And I got to switch the sign, right? Because it's going to give me a positive number. So let me flip the sign here. Let me format this the way I want. And now I've got cost of goods sold that I'm forecasting of 824. And again, I'm going to copy and paste this across. And all that's telling me here is, okay, I am, this is my expectation. At a 37% margin, this is what I think it's going to look like. I'm almost done here with the core operating income statement. I just have to calculate these operating expenses, also known as SG&A, or selling general and administrative expenses. This becomes even easier. It's simply that 150. I got to flip the sign because I've got these things inputted as negatives. And I've got 15% historically. Again, I could take the average. So I can actually just copy and paste this formula. And so now, because I'm lazy, and I'm just going to take that revenue times the 15%, and I'm going to have to flip the sign. Again, if you had add-ins, you could automate this a little bit more, but it certainly isn't taking that long if you know your shortcuts. And then I'm going to copy and paste this formula across, which does all my heavy lifting for me. And so now I'm forecasting operating profit, done quite a bit already, for this hypothetical company. And that operating profit is growing all the way to, $424 million. Right. Now, interest income and interest expense, when you're building a 3-statement model, I'm going to copy and paste the formula, but I'm going to leave this blank for now because this area, in fact, I'm going to shade it a bit so that you kind of remember that we have to go back to this. The reality of it is this is going to be forecast once I forecast my debt and cash balances on the balance sheet. So we're going to wait on that. That's actually going to come later on. Tax expense I can already do, or at least I can sort of arrive at formulaically because my historical tax rate is simply my tax expense is divided by. Now, before I give you the answer, think about what is my tax rate. The tax rate is not tax expense divided by net income. It's not tax expense divided by revenue. It's your tax expense divided by your pre-tax income. And I'm going to flip that sign again because my expenses are always inputted as negative. And I'm going to do the same thing, assuming sort of an average tax rate going forward. I'm going to reverse the reverse the sign here, 29% times the pre-tax profit. And I'm getting my expected amounts. Now, one thing to note, this number, and therefore this number will eventually change when I put this data in, but this is formulaically already correct. Again, let me just get the formatting right. Since I'm lazy, I can grab the formatting from somewhere else and do a paste special formats. And then I can copy and paste this formula across. So believe it or not, the core income statement is done, right? Of course, that's not all there is to a 3-statement model. We now have to build the other 2 financial statements. But that is our job, right? But we're a third of the way there. And in fact, what you're going to see is a core takeaway from a 3-statement model is that the income statement drives a lot of what happens next. In fact, the income statement drives most of what happens on the balance sheet. And it also drives most of what happens. And then I should say, in turn, the balance sheet drives everything on the cash flow statement. So if you haven't recreated this on your own yet, now is a really good time to hit the pause button and try this yourself. Okay. And with that, I think we're ready to hit the balance sheet to really get going here on the next step. So we're going to write down the balance sheet. By the way, when you're building 3-statement models, when they get really long, some people do prefer to start putting the income statement and the balance sheet and the cash flow statement in different worksheets. My preference personally, is to, as much as possible, keep models longer as opposed to across multiple worksheets. Obviously, that doesn't work when you're working with a lot of data, a lot of raw data that you have to synthesize. But a model like this, those 3 statements, this is going to be less than 600 rows, which is kind of generally my cutoff. If you want to go more than 600 rows, it's time to sort of move into multiple worksheets. But let's go down here. We're going to keep this nice and easy. One thing that I like to do is, I like to be able to go back and forth between, as the scrolling is going to get difficult, you'll see I have a little thing that I like to do to set up my balance sheet. First line in a balance sheet is cash and equivalents. So let's write that out. We have cash and equivalents again. The next thing that you're gonna see are things like accounts receivable. You're gonna typically see these are what we call working capital assets. This is money that's owed to you that you expect to collect within the next year. And then we have typically a line called inventory. Every balance sheet is going to be a little bit different, but what I've laid out here is what I think are probably the big ones. And then you typically have, you might have other things like prepaid expenses and other working capital assets. Let's just kind of keep that loosely. And then you've got, and if this is the big bucket for current assets, we can actually probably bucket that up. And then you've got usually what are longer term assets. These are things like property, plant, and equipment. These are fixed assets, machinery. And then you might have intangible assets. Those are things like brands and patents and things of that nature. So now let's, again, expand this. And now you've got your non-current assets. Right? That's kind of the category for this. And then you've got ultimately total assets, right? So total assets is going to be all of it. So now that we've got the basic headers for assets, remember we still got to do liabilities and equity. So now let's just kind of put some numbers on. And, I'm going to scroll back up. I like to see what's going on up here. So I'm going to hit Alt-WS all the way on the left of the screen. That's going to sort of keep that pane frozen for me so that I can see what's going on. And so let's say historically this fake company had... And again, what's nice to see is if you've got interest income of 7, realistically, let's give this company something like, 300 million in cash. And let's do something kind of in that boat. I want to make this kind of realistic in terms of what the numbers are. So if you have interest income of 7 million, you probably need a good chunk of cash and equivalents to generate that kind of return. Accounts receivable, you have revenue of 1,200. This can vary widely depending on the kind of business that you have. So let's put this at, 200 and let's make this a little smaller, 54. Again, there's no real rhyme or reason to this other than I want to make it kind of realistic in terms of its general relationship to revenue. In inventory, this company does have a lot of, cost of goods sold. So Let's just say that it needs a lot of inventory, and it probably doesn't turn the inventory over very quickly, meaning it has to hold on to a lot of inventory to support the business. Not necessarily a great thing operationally. That's what we're saying about this business. And then prepaid expenses, things like utilities, wages and rents, and anything else that might not hit those sort of other working capital assets, we're going to put in here. So let's just keep this nice and simple, and so that our total current assets are like this. And now we get to forecasting. So actually, let's finish this and then we'll talk about forecasting. So property, plant, equipment. Let's say you have fixed assets, land, machinery, buildings, a whole bunch of stuff. And let's say the value of that, and again, this represents the value when you purchased it, is sort of in this kind of area. Again, just making up some numbers that I think are going to work for us. And then let's say we've got some intangible assets as well. So that your non-current assets, let's sum those up. And your total assets are your current assets plus your non-current assets. So now we're ready to forecast. So in order to forecast cash, just like interest income and interest expense, we're actually going to shade off. This is going to be one of the very last things that we forecast. So we're going to leave that off because this is going to be a function of your cash flow statement. So really then we turn to accounts receivable as the very first line that we forecast. And accounts receivable, one of the interesting things is, if you don't really have a view on accounts receivable in terms of whether the company is going to be more aggressive in collecting on its accounts or anything like that, you're just going to grow this. The sort of the natural relationship is revenue. So you're going to say that, the more revenue I expect to generate, the more my accounts receivable will grow. That's sort of the typical default forecast. And so I'm actually just going to tie this. I'm going to hit F6 to jump up here. I'm just going to tie this to my revenue growth rate. And just like that, you might be surprised to find that this is the most typical way to forecast receivables. Simply tie it to your revenue growth. For inventory, we're going to do the same thing, but we're going to tie it to cost of goods sold under the logic, the intuition that, hey, as I sell more stuff, I'm going to need more inventory to support that. Now, I never really had a cost of goods sold growth rate. So I'm just going to put that off to the side for a minute. In fact, I could probably put it in here as a memo. Just so that I don't get too complicated with my formulas. And I'm just going to say, okay, here's my cost of goods sold growth rate. This year's cost of goods minus last year's cost of goods is 6%. And I'm going to paste that across. And so I'm simply going to grow my inventory last year by 1 plus that cost of goods sold growth rate. Okay, we're almost there. Prepaid expenses and other working capital assets. Here, I don't really have anything fundamental that I can tie it to other than what is a typical assumption for working capital assets, which is basically just to say, hey, you know what? As the revenue for the company grow, I'm going to just assume that working capital assets, things like this, how much I prepay in utilities and wages and rents, that does tend to grow, maybe not one for one, but it does tend to over the long run grow in line with revenue. So I'm just going to grow this with the revenue growth rate. Now, like I said, in our full course, you're going to get a lot deeper into all of this, and you're going to, we talk to all the potential other ways you can forecast it. And if you do have a thesis on certain relationships, how you can get more fancy with bells and whistles and the modeling around it. But that's not the purpose of this. The purpose of this is to just get the 80-20 on this, right? To just get what is typically done, what's the most sort of natural relationship. Now I'm going to copy and paste the current assets. And, all of a sudden, let me just get this formatting consistent because I hate when the formatting is off. 1 decimal place, 1,000 comma separator. Here we go. And now, believe it or not, we have our current assets already done. So again, we are flying through this 3-statement model. Again, this is going to be a placeholder. So when I figure out what my cash balance is going to be, this is all going to change. But for now, we're holding it blank. So right now, there's sort of 3 to-dos on our to-do list: the interest income, interest expense, cash and equivalents. Next, we turn to property, plant, and equipment. This one's a little bit trickier. This one's a little bit trickier to forecast because we don't quite have all the details yet. For those of you who remember your accounting in school, this is going to be helpful for us to think about. PP&E, or property, plant, and equipment, at the beginning of a period, if it's 100, what makes it go up? Well, it's going to be what we call CapEx, or purchases of new PP&E. So let's say that's 20. Again, I'm going to expand this out. What makes it go down, though? What makes it go down is something called depreciation expense. Maybe other things like asset sales and things, and write-downs and things of that nature, but 9 out of 10 times, for in the ordinary course of business, you're just going to reduce it systematically by something called depreciation expense. And let's say the depreciation expense for a company is 10. That means your PP&E at the end of the period, EOP, is going to be 110, right? It went up by CapEx, went down by depreciation. But now, for those of you who are now trying to remember, go back to your accounting, if you've taken accounting in the past. If you haven't, I would recommend you go through our accounting course. It's going to be, otherwise you're going to start getting lost here if you've never taken accounting. The next question, but then the question is, where is this depreciation expense coming from? So if you remember from accounting, CapEx, it doesn't really hit the income statement. These are capital purchases. We're going to deal with them on the cash flow statement. But depreciation is actually usually buried within these two line items. I mean, most companies will sort of not identify it separately. It's just buried in here. And then you kind of see it as an add back on the cash flow statement. So what we're going to need to do is we're going to need to make an assumption now to be able to forecast this. Is we're going to need to have like a memo up here right next to where we put the cost of goods sold memo. Let me open this up. And I'm going to add another couple of memos here. Memo, depreciation in OPEX and COGS. And let's say that is going to be, let's say that buried in here, there's depreciation of 35 million. The prior year was 30 and 25. Right? And companies will disclose what their depreciation was. You have to read it in their footnotes. So historically, that's what this was. Let's get the formatting right. So now we're saying, look, it's going to be that. And the way we're going to grow this is we're going to grow this really simply here. Now, I will say this is a simplification, and in our full modeling course, we get into the details of how you do this, but we're going to keep this simple. We're going to simply grow this with revenue. We're going to say as the business grows, it'll buy more equipment, and therefore it'll have more depreciation expense. Again, simplification here, but it's going to get the job done for us. So now that we got depreciation, since we haven't built the cash flow statement yet, let's also make our assumption for capital expenditures. And so this, let's say, historically this is how much you're spending in cash every year on purchases. This is going to show up in the cash flow statement. And we're going to grow this with revenue as well. Same idea. So I'm going to grow this times 1 plus the revenue growth here. Now, you may be wondering, why did I put this as a negative? Well, the reality is it's going to be presented very soon as a cash outflow on the cash flow statement. It costs us money to spend this. In fact, I'm going to switch this to a negative 2. This is an expense, isn't it? So let's go back to our kind of typical thing of expenses as negative. The signs here get a little bit confusing. So I'm going to do the work here and then just make sure we're clear. Depreciation is an expense. It is typically buried in here. And so we're going to put that in as a negative here. We're going to just have to make sure that when we forecast PP&E on the balance sheet, that we're keeping the signs clear. Capital expenditures is a cash outflow. So that's going to be put in as a negative on the cash flow statement. So in anticipation of that, it's going to go down. What makes this confusing, as you'll see in a second, is CapEx actually makes your PP&E bigger and depreciation makes your PP&E smaller, as we just saw. So we're going to have to do some work with the signs so we don't get too confused. So let's go ahead and do that now. So property, plant, and equipment, if historically this was the relationship, and by the way, if for those of you who might be really paying attention, you might be wondering, well, actually, shouldn't this be a formula? If property, plant, and equipment in the beginning of the year was 210, can I get to my 243 simply by taking 210 plus, my CapEx minus my depreciation, shouldn't that give me close to 243? And why doesn't that exactly match? That's a very good thought. Theoretically, it should match, but in reality, historical filings, you'll almost never get it exactly right because companies are doing a whole bunch of adjustments constantly. There are asset sales. There's all other stuff that's always going to sort of make this relationship historically such that you just want to put in the actual historical results that the company provided. So again, let's do our sort of go-to special. Let's get the formatting right here. F5, S, let's make sure this is blue. And here's my favorite blue here. Oh, that's not what I wanted. I wanted fill. I wanted my font right here. So Alt-C. Here's my blue. Alrighty. So at this point, going forward though, I do want to use that forecasting approach. So I'm going to take property, plant, equipment. I'm going to add, which means I have to put a minus sign because I'm minusing a negative. So I'm going to add CapEx, and then I'm going to add the negative depreciation. So I'm basically doing what I did here, which was easy to see, but because of all the sign madness, it's a little trickier. So make sure you're following. I'm growing by CapEx and I'm subtracting by depreciation, and I'm copying and pasting it across the board such that now I have my property, plant, and equipment. Okay. There's one last thing left to do, which is intangible assets. By the way, they work the exact same way. Intangible assets. So this will be much more streamlined now. Intangible assets, BOP, grow by purchases of intangibles. They go down by amortization expense, which is the cousin of depreciation expense. So if we talk about depreciation expense, we mean the reduction, the systematic accounting reduction of the value of fixed assets. Amortization expense is a systematic reduction of the value of intangible assets. It's the exact same thing conceptually. Intangible assets, EOP. This is how we end it, and it's the same kind of math. If we start with 100, we purchase 20. We had intangible asset amortization of 10. We end at 110. So we're going to need to do another memo because these intangible assets are the amortization every year historically is also buried within these operating expense line items. Every now and then a company will identify them separately in here, but usually they're just buried in here. And then on the cash flow statement, you see the cash impact of the purchases of intangibles. So let's add another couple of memos here. Again, we want the same thing for amortization in OpEx and COGS, and you want purchases of intangibles. And so let's do, minus 10, minus 12, minus 14, and then purchases, let's say minus 16, minus 18. Again, same issues with sign, so not much to kind of belabor. I'm going to apply the same formatting. And in fact, it's the same formula. In our full course, we go obviously much more deeply into the different types of ways you can forecast this. But at a basic rule, if a company is growing and we don't have any opinions about what it's actually going to do in terms of purchases or amortization, we're not building full-on schedules. We're simply going to just grow it with revenue. So we're going to do the same thing. Just tie it to revenue. And then the formula down here becomes very much the same thing. Historical intangible assets, minus the negative, which means plus the purchases of intangible assets, minus amortization gets you to the end. So now I'm gonna format this nicely. And I am done. I am done with my total assets. So let's get the formatting right. So at this point, we have completed the asset part of our balance sheet, and we turn to the liability and equity part of the balance sheet. If you haven't finished this, if you haven't been hitting the pause button to go along, now is a really good time to hit the pause button and create this yourself. All right, so now that we have finished the income statement, the balance sheet, except for a few key line items, or at least the balance sheet assets, let's turn to the balance sheet liabilities and equity. So we're going to start with working capital liabilities. So in the same way that the company has accounts receivable typically, and typically they have inventory or prepaid expenses, companies typically have some working capital liabilities. Accounts payable being probably the biggest one. Accounts payable is money that is owed to vendors, suppliers, right? Then you're going to have something called accrued expenses. Typically, expenses you owe, like accrued wages, all kinds of money that various constituents that you engage with, you owe them money, but you haven't paid them yet, right? So accounts payable is a specific type of group like that. Accrued expenses and other is kind of a catch-all bucket, usually relates to accrued, wages is a big one. Could be taxes payable, a whole bunch of other stuff that we're going to lump into this other bucket. And that's going to get you sort of your big, current assets or current liabilities. Let's say, let's have another catch-all, which is other working capital, or let's call it other current liabilities. And that way we kind of are more realistic that companies will have other stuff. And so here, let's put in some dummy data. I'm going to try to make this as realistic as possible. We're going to have some accrued wages and every company is going to be quite different. The point here is we want to be realistic about the kinds of line items you're going to typically see. So I think that gets the job done. Total current liabilities. And now let's sum them up. And now in terms of forecasting, when we're talking about operating liabilities, these sort of typically what falls under other current liabilities like accounts payable, accrueds, and other, it's going to be very similar to the work that we did with accounts receivable, inventory, prepaid. So that's sort of what makes this simple. If you really break down, think about the work, the balance sheet, as I sort of foreshadowed, the balance sheet is very much driven off of quite often just the revenue forecast. I mean, think about how many line items, and we're going to do the same thing here. How many line items are being driven off of revenue? And so we're going to do the same thing. The idea is the company grows, the amount that you owe to vendors is going to grow. That, by the way, there is an argument to be made to growing this, to tying this with cost of goods sold. The same idea that, the vendors are typically, the ones that provide you with like inventory. And so you could tie it to this. If you believe, for example, the company you're modeling, that really most of the payable is coming from inventory, from suppliers that supply your inventory, well, then you could tie it to that. So why don't we just do that? Let's just say that's what we believe. Accrued expenses and other, these are things like accrued wages. Well, as the business grows, we have this sort of like rough proxy, right? In the absence of any real information, and in our full modeling class, we always talk about this. In the absence of any other information, sometimes you will have that information, but in the absence, you are going to tie these forecasts to their most natural operating partner. And almost always that's going to be revenue. So let's do that across the board. And now let's just make sure we get our formatting here exactly how we like it. And just like that, very quickly, we've been able to do this. You might be surprised how often in reality it boils down to that level of simplicity. I'm going to get the formatting sorted in a second. First, I want to get to debt and non-current liabilities. This is where a lot of the action in modeling ends up happening. And that is debt. Your debt is a liability. In fact, let's call it long-term debt. Let's create two line items, actually. In any good three-statement model, you're going to need to have long-term debt, and you're going to need to have something called a revolver. And this is a line that you need in case your model is showing you that you're losing cash and you're going to need to borrow extra. So let's say historically, and this is where we kind of go back up here, and we said historically the company has had, this interest expense presumably from its long-term debt. So let's say it's got, debt of, 167. Again, I'm just creating numbers that I think are obviously fake, but I think are realistic enough where we can use them and the numbers will look reasonable. And let's say historically the company has had a revolving credit line. Think about this as a corporate, credit card where they haven't really drawn on it. Maybe one year they did draw on it. The next year they almost fully paid it back by the end. And this is kind of what they've got, their sort of corporate credit card. And then we've got really, if this is the big debt items, let's have a line item for other liabilities. In case we're missing something, other companies can have lots of liabilities like that aren't necessarily factored in any long-term liabilities like leases and things like that. So let's just have another category in here. We're not going to spend too much time talking about some of these others. It becomes a little bit more complex. Total liabilities. We are going to add all this up. Now, for long-term debt, let's assume that it stays flat. Let's just assume the company doesn't borrow much more. And let's assume that other liabilities, things like leases, and this is where, again, the nature of this really matters. Because once you go down here, you don't typically tie to revenue unless you really do think it's tied to revenue. Like here is where you'll often see models just simply keeping things straight. Once you go below current liabilities, you start seeing models just grow this flat. Again, the real correct answer is a function of what are these line items. So we're going to keep this in line with what we typically see. And the revolver, just like cash, is going to be something that we look at later on. So we're sort of putting in the pieces, the placeholders, for the things that make this model balance and work by the end. So let me just get the formatting right. And now I'm also going to do what I've been kind of waiting to do, get enough data, and let's get this paste special so that I can color everything the way I like, constants. And I want to make sure I'm only coloring these constants. Let's color this my favorite blue. There's my blue right there. And my balance sheet is almost ready. So there wasn't much action here other than eventually when we tie this model together, when we think about what we call a fully integrated three-statement model, it's this section right here that really has to tie all of these line items that up till now have been shaded gray. You can see they're all kind of connected, aren't they? They're all related to this sort of financing part of not operating, but financing aspect of the company's operations. Now we turn to equity. Now, in terms of equity, the typical line items you're going to see is you are going to see common stock and additional paid-in capital. You are going to see something called treasury stock, which is the company buying back stock. You are going to see, you're going to often see something called other comprehensive income. This is kind of a junk category we'll talk about in a second. And then you're going to see retained earnings. Okay. These are the typical line items that you see: total equity, and then you're going to see total liabilities and equity, and that should equal your assets, right? So let's put in historically some numbers. Common stock in APIC represents the value at issue of any of this company's stock. So quite often this is significantly below the actual value of the stock that exists. This is book values. Remember, accounting is done on a book value basis. And as a result, companies that buy back shares, since they're buying it back in the open market, a lot of times the stock price has gone up to the point where the treasury stock is even higher and more negative, right? This is what we call in accounting a contra account, is higher and more negative than the actual original issuance of stock. So that confuses people a lot. It really shouldn't. It has to do with the fact that accounting is done on a historical basis. So treasury stock, you're buying things at a much later time, and therefore they're often much more expensive than when they were issued. Other comprehensive income, this relates to things like that don't really show up on the income statement. They're like accounting gains and losses that don't quite hit the income statement. They hit another kind of almost like a weirdo, bizarro income statement. You'll see it if you open up a 10K. There's sort of a fourth income statement called other comprehensive income. And it's like gains and losses on foreign currency translations, derivative gains and losses, things like that. So it can kind of swing wildly. Usually sometimes it's up, sometimes it's down. And it is what it is. So we're just going to forecast that here. And then retained earnings is the sum total. For those of you who remember from our accounting class, it's really the sum total of all the net incomes ever achieved by this company up until this moment, right? So 172 is the last flow of all the net incomes ever, ever achieved. So, we're gonna sanity check this because we've made up the dummy numbers. Our retained earnings number really needs to be a plug just to make the numbers work. So I'm gonna sort of build up my historicals here, and then in order for everything to work, my total liabilities and equity actually must equal, right? And let me make sure that I get this right. Did I get no? Actually, this is good. I caught a mistake. My total liabilities need to also include my total current liabilities. Otherwise, nothing would have added up. All right, so here we are. You caught that? Originally I just calculated total liabilities. I did not add the current liabilities. So let's make sure that that's in place. And now total liabilities plus my equity. This must equal my total assets, right? This must equal my total assets because assets must equal liabilities plus equity. So my retained earnings, just for the sake of this exercise, I'm going to have to like get exactly right. So what is my total assets? My total assets are 698 million bigger than my liabilities and equity. So that means to me that retained earnings must be historically 698 here to make this work. So now my total liabilities and equity exactly equal my total assets. This is often a feature you see in a model, like it's a balance check. Usually you don't have to worry about it historically because the company provides you all the correct historicals, but you do need to sort of forecast this out, for the future to make sure that it does work. Balance, does this minus this equal 0? If it does, then you're in good shape. And so you're gonna sort of paste this across going forward. So I want to make sure, so this is going to be 743 to make it work. And this is going to be 807. And so hopefully everyone recognizes what I'm doing here is just because I'm using dummy numbers. They actually do need to match for this conceptually to make sense. Liabilities and equity historically for any company must equal total assets. So now I'm going to keep this balance sheet because it's going to show you eventually this also, the key to a three-statement model is that on a forecast basis for any real company, everything balances as well. So we're going to keep this here. This is a nice sanity check for us about whether when we're done, and it's only going to be 0 when we're done, whether we've done everything correctly. So now let's get to the fun part. This is one of the more fun parts about, forecasting the balance sheet. Common stock and APIC. Well, the question for us is, are we going to issue any more common stock and APIC? So let's make some assumptions. In fact, I'm going to bring a bunch of this down. And in a real full-scale modeling exercise, you're going to create schedules and really do a lot of work here. I'm going to keep this super simple. I'm going to create a little bit of room in between each one of these. We're going to have like mini schedules so we can do a little bit of analysis. Common stock and APIC. So I know that historically, my last historical common stock and APIC was 39. Well, what makes common stock and APIC go up? Well, only if you issue stuff. All right, so we're going to call this, if this is my beginning of period balance, and I'm going to introduce here kind of a modeling mechanism for like rolling forward forecast. So if my beginning of period in this year is last year's end of period, that's an important concept. Last year's end of period is the beginning of period this year. New issuances of common stock. Let's assume that the company issues 5 million through stock options and restricted stock every year. That's what's going to happen. And so what does that mean? At the end of the year, common stock and APIC end of period is going to be 44. And now the way that I'm going to roll this forward, that's why it's called a roll forward, is I'm going to take last year's balance and then I'm going to just sum this across. So if I forward this, let's get the right formatting. All of a sudden, I've built a very rudimentary roll forward for common stock. And a lot of times people confuse flows and balances. So in a model, people, especially when the models get long, they might just say, oh, I'm going to issue, more common stock, so I'm just going to forecast that. Well, that's confusing flows and balances. Remember, what you want to model is the end of period, the next period's end of period balance, which already reflects these new issuances, right? So again, we're going to color code this. These are hard coded. This always makes it easy to kind of hone in on what is actually being changed and changeable. Next, we do the same thing for treasury stock. Treasury stock is conceptually a little bit difficult to wrap your head around, but when you think about it, it's the same thing, just in reverse. Treasury stock represents the value, the negative value of all the shares the company has repurchased from existing shareholders. As a reminder from accounting, it's a contra account. So what that means is if the beginning of period in the first forecast period is, whatever it was at the end of the period in the end of the actual last actual period, well, what's going to change every year? Well, if the company buys back new shares, new repurchases. So let's say every year the company keeps buying back. And there's a whole bunch of thinking around why companies buy back, should they buy back, how similar that is to dividends, how different it is from dividends. But the point is, every year that a company buys back, and let's just assume they're going to buy back 20 million every year, we build the same roll forward as we did for the common stock. I can apply the same formatting because I'm lazy. And you can see the contra account just keeps getting more and more negative. And again, setting up a roll forward schedule like this makes it really easy to simply loop back into the balance sheet. Really easy. Other comprehensive income, you could run it the same way. The reality of it, though, is because other comprehensive income is usually all over the place, we almost never assume any change. How can I predict what foreign currency translation gains and losses are going to be? And so in almost every three-statement model, this line you tend to just forecast as a straight line. All right, so we don't even have to worry about that one. We got one line item to go, and that one is the one that most people remember from accounting class, and that's retained earnings. And we're going to build this similar roll forward in retained earnings. We're going to say retained earnings at the beginning of period is whatever it was at the end of the period in the last actual year. Well, what makes retained earnings go up year after year? Well, if you may recall from accounting class, net income, retained earnings represents, as I just mentioned, the accumulation of all net income the company has ever generated. So net income is simply linked. Now notice we've already done this work, so we don't have to make any guesses. Now you're starting to feel how this model is going to get integrated. We don't need to say anything about net income that we haven't already said. So we're going to link it. And we also remember that eventually this number is going to change a little bit. Just keep that in mind. That's going to become an important part of what we have to think about later. This number is going to change a little bit because we still haven't finished net income, right? It's going to be impacted by interest income and interest expense. So now we've got that. And those of you who are really awake during accounting class, I unfortunately cannot claim to be one of those people, but ended up having to learn this on the job, is retained earnings goes down by dividends. So dividends, any common dividends that are issued, right, that the company has ever issued, that's going to reduce retained earnings. And conceptually, you can think about it like this. Retained earnings is what the corporation has retained. So anytime net income goes up, that's more earnings that the company has, but then they distribute. Anything they give back to shareholders in the form of dividends comes out here. So let's say historically we haven't said anything about dividends because remember, dividends do not show up on the income statement. They show up on the cash flow statement, but they are not considered part of the operating performance of the business. They are simply a distribution to shareholders, and so they're not going to show up on the income statement. Let's say every year the company issues 150 million in dividends. Again, we haven't made that assumption yet, so we're making it here. And that's your retained earnings at the end of the period. And so again, we build this roll forward. We copy and paste this across. And we are done with everything but the formatting here. So let's, in fact, again, let's get this right. So number. So let's get this right. Let's get the formatting for the hard-coded right. And now we are ready for business. So this is a slight, it's different from just forecasting with revenue. And once you get down to this area of the balance sheet for a lot of line items, you start having to build these logical schedules. So here we are, we're going to link this again. We don't want to make a typical mistake of, linking income or anything. We just link to the end of period balance. The reason why we couldn't do it just on the face of the balance sheet, there's a little bit more work to do. We link that across. And what you see is, we're not quite done, right? The model still isn't balancing, and that's because we haven't done the cash flow statement yet. These line items are still missing. What's the cash balance for the company? What's the revolver? And ultimately, what's going on the interest income and interest expense? So if you're not done at this point, if you haven't been hitting the pause button to follow along, now is a good time. I'm gonna identify here. We got schedules. So this is kind of a nice way for us to kind of separate this. So we've got the balance sheet. We've got the income statement. We've got some memos and supporting schedules. The next thing will be the cash flow statement. Hit the pause button, get this all wrapped up, and then let's move to the cash flow statement and we can start tying this up. So believe it or not, we are almost done. All right, we are ready to start wrapping this up. We're going to turn to the cash flow statement now that we've built the income statement and the balance sheet. Let me just bold a few things, make sure that we fully got this nice and visually clear. Now let's turn to the cash flow statement. Now, one thing I'm going to add that I like to do once these things start getting kind of long is I start adding what we call elevator drops. These are little X's that let us sort of quickly jump from one schedule to the next, especially because we like to put all of our financial statements on one long file. So what this means is if I say, okay, guys, let's get to the balance sheet, let's get to the schedules, let's get to the cash flow statement. These little X's, little elevator drops mean I can hit Control down or up, and I can quickly jump to where I want to be. So now with the cash flow statement, think about the cash flow statement is really just a reconciliation, almost like a magnifying glass on what happens year over year to cash. So all the changes that we've reflected here on the balance sheet have implicit cash impact that we have to get exactly right to make the model work, to get our cash equivalents to be correct so that when we're done, we actually get a zero balance, right? It's just, and so that work is probably the most confusing in accounting class. Always the most confusing thing is constructing a cash flow statement once you're given an income statement, a balance sheet. This really becomes the Excel version of an accounting final exam. So let's start. We know that most companies use the indirect method for the cash flow statement, which starts the starting line for the cash flow statement is the final line of the income statement, net income. So that's the indirect method, as it's called. There's another approach, which is maybe more intuitive, called the direct method, which starts with, well, how much in receipts did I get? How much cash disbursements did I get? That's not what you'll almost ever see in actuality when you're dealing with audited companies. So we're going to start with net income. And again, we're only focused on the forecast. We don't spend really any time on the cash flow statement trying to audit the past. This is simply an exercise designed to get us what is the projected cash balance supposed to be. So I'm going to reference this in here. This is the first line. And understand that the challenge now that I've got this first line, is to look at every single line item on the balance sheet and make sure that I am accurately reflecting the year-over-year changes in that balance sheet on this financial statement. And if I get it right, my model should balance. Okay. So the very first thing, there's a certain order to this, which is I need to tick off the working capital line items on my balance sheet. So I'm going to start with accounts receivable. In fact, I'm just going to copy and paste these so I don't miss anything. And then I'm going to copy and paste the accounts payable related working capital items. So I'm going to make sure that I get the impact of all of these correct. And the order of the cash flow statement really starts with net income and then these line items. And as I go through them, I'm going to tick them off, right? Because I want to make sure I get every single line item here. Now, I don't want to put X's here because that's going to confuse the elevator drops, but you're getting the idea. You'll see that I'm going to capture every single line item, and there's an order, a prescriptive order for how that's typically done on the cash flow statement. The companies have to sort of present this. The first thing is net income, then working capital, then depreciation. Actually, sometimes depreciation is first. But let's start with, actually, in fact, why don't we do depreciation first? Because you do typically see that right before the working capital. So the very first thing that we're going to have to think about is depreciation and amortization, and adding that back. So why do I add this back? You've probably seen this in accounting class. You remember that we sort of defined, we said, hey, inside here, there's a whole bunch of depreciation and amortization. Well, that depreciation and amortization, understand implicitly, is going to lead to a lower net income because it's an expense, but it's not quite a cash expense. And so what we're trying to get from is net income to cash from operations. In fact, think it'll be easier for me to show you where we're ultimately trying to go. We're ultimately trying to get to cash flow from operations, right? So I'm almost trying to move from net income, which is an accounting-based measure of profit, GAAP, accrual principles, etc., to cash in my pocket. Like, how much cash from operations did I achieve? Well, the very biggest thing for most companies that is really, that is the difference between GAAP accounting and cash in my pocket as a result of operations is often these big non-cash depreciation amortization amounts. So I put them in here. So I'm gonna grab them. Now notice these are negative, right? They're negative expenses, but these are lowering net income, and I'm trying to get back to what the impact would have been without them, which means I need to flip the sign and I need to add them back as a positive. That's a thing that always sort of confuses people. Well, remember, this is inside, it is artificial. If my goal is to get to cash, depreciation amortization is artificially lowering net income by non-cash expenses. If I back those out, now I get something more closely resembling cash, right? This is ultimately, I'm going to sum all of this, right? So now instead of net income being 207, cash in my pocket, even though I still have a little bit of work to do here, is already higher because depreciation and amortization is not really cash. So now we turn to some of the other things, the working capital items. So actually, I'm going to put this off to the side. If you think about, to get to, cash from operations, you start with net income, you add D&A. Oh, I want to sort of not have Excel think that that's a formula. D&A. I want to add changes in working capital, and then I get my cash from operations. Really, that's kind of when I'm good. So now let's add my changes in working capital. So working capital, the one thing to kind of remember here logically, because there's a certain rule here. The rule is the year-over-year change in working capital. There's a negative impact of that because it's an asset. But just think logically, if accounts receivable are going up, that is money that I have. That means there's customers owe me more money. That means that this 207 that reflected a whole bunch of revenue, there's more of this revenue that I haven't been paid yet because my accounts receivable have gone up. And so the way to reflect this correctly conceptually is to look at accounts receivable. Oops, where did I go? Is to go in here and say, if accounts receivable went up, right? It's actually the reverse of that is what's happening to cash. And really that rule conceptually applies across the board. If inventories have gone up, that's an outflow as well. And the logic being, as inventories are going up, you have to spend money to acquire those inventories. In fact, in accounting class, they just had you memorize a rule, which is as assets are going up, that's an outflow. That's a source of funds. That's a use of funds as assets are going up. And as liabilities are going up, that's a source of funds. And so, I always like to conceptually understand why this is happening, right? So as prepaid expenses, let's say you prepaid for utilities. If you're prepaying more utilities, well, that's cash going out the door for prepayments. That's the logic of why this is happening. So we're just sort of simply copying and pasting this down. And now we skip down to working capital assets. As I mentioned, there's an order to this when you're constructing the cash flow statement, which starts with, working capital assets and then liabilities. And it's the reverse, right? If your payables, if all of a sudden part of your results is that you have more payables, that means you avoided paying cash. You avoided paying cash for your cost of goods sold. And so the reverse is true. This increase is actually a source of funds. And you could copy and paste the exact same logic all the way across, such that when you sum up all of this, and I think we pretty much got everything now, the total cash flow from operations is not your net income, your starting point. It's higher than that, mostly because of D&A and the impact primarily was not sufficiently offset by the working capital assets. So this is how much we're saying went into our pocket. And notice we ticked off a bunch of the balance sheet line items already. So the next step is the other two sections of the cash flow statement, which are related to investing activities and financing activities. Believe it or not, we've done most of the work there already. We just have to bring it all in place. So investing activities, these related to cash flows from operating activities. Well, what about investing in the long term of the business? That's that spending on capital expenditures that it's referring. Typically, we're talking about is purchases of CapEx and purchases of intangible assets. These are things that have long-term value for the business. Well, we've already defined what that is, right? Up here, we already had to kind of work through that. And that is, we spent $73 million. We're forecasting we're going to spend $73 million on CapEx. We're spending $23 million in purchases of intangibles. And the sign here is correct, right? Because these are outflows. We're spending this money. Cash for investing activities, right? So here we have these amounts. And so, you can think about this business now as, okay, well, we generate $240 million in cash every year, but, we got to reinvest, almost, 30, 40% of that back into the business, $96 million. Last but not least, where the rubber meets the road, where this course really starts coming to an end, is cash from financing activities. Well, let's take a step back before we dive in and understand, well, what is still left to be done? What line items on the balance sheet? If I alluded to the fact that, we got to get all the balance sheet line items. Well, what have we already got? I'm going to put this off to the side here so we don't mess with our elevator jobs. We already got receivables. We already got inventory. We already got this. We just got that. We got all of these. Well, what's left? What's left is all of these other line items, right? Really everything on the, liabilities and on the equity side. So I'm gonna go ahead and start thinking through these. So let's start. We got to get every one of these, otherwise our model is going to be out of balance. If we miss anything, our model is out of balance. So let's go down a list and start taking care of this. So the first thing is debt, long-term debt, right? So let's actually be specific here because debt is the most confusing part here. Long-term debt. Well, are we expecting any inflows or outflows from long-term debt? Actually, no, we were pretty prescriptive here. We don't think anything's going to change. Debt's going to stay at the same level. And so we're going to use the same logic of kind of connecting the balance sheet to the cash flow statement. This is critical. This is what makes the model integrated. That you're always connecting anything that can be and should be connected. So long-term debt, had it gone up, that means we would have been borrowing more. That would have been an inflow. Let me show you what that looks like. I'm just going to, would have been a source of funds if we borrowed more, right? If we just said, what, we think debt's going to go up, then we would want to show an inflow of cash because when you borrow, you get cash. But we actually said, no, we're not going to make any changes to debt. It doesn't mean we just, put in a zero. We want to get the model architecturally sound so that if we change assumptions in the model, it's still going to get it right. So now we got this one. Now the revolver, I'm going to still leave blank because the revolver is the very last thing. But now let me turn to other liabilities. Other liabilities. Now this could be anything. I've kind of have this as a catch-all bucket. The nice thing is, logically, it's the same thing. Any growing liabilities, presumably I got cash as a result of those growing, right? So if this liability sort of grew, that would have been reflected as an inflow. Again, this is an other category. I wanted to put it in other just so you see it because it's realistic. You're going to see a lot of companies with other. You don't necessarily know what they are. You want to make sure the model balances. So you want to formulaically get it in there. So now we got that one. Okay. Now let's move on to common stock and APIC. So now I'm going to paste all these in. I want to make sure I'm getting all of these. Accurately. And I'm going to leave retained earnings because I already got a portion of it through net income. So I don't want to double count. Common stock and APIC. Well, here I've already made the decision. I don't anticipate any cash coming in. So this is just a zero. Again, notice I'm formulaically building this out so that if you did have a thesis on that, it would be reflected correctly. Or let's say you said, oh, I think we're going to have losses. That's going to be outflows. So we got it in there, formulaically correct. Treasury stock. So treasury stock, I can go in here and sort of do this minus this and reflect correctly that, there's these repurchases, or probably safer when you're modeling to go directly to the source. These are my repurchases. And in fact, when you look at a cash flow statement, you're often not going to see treasury stock. You're going to see repurchases. All right. How much cash you spent on buying back shares? What is going on here? Did I miss something? Because I think we had something on. Oh yeah, I missed. I was using APIC when I really should have been talking about common stock. Common stock, it's the same issue. We are saying common stock is growing. So, this actually belongs right here, right? ACI, other comprehensive income, there's nothing happening here. But with common stock, there is something happening. We're forecasting, issuances, and this is usually going to be listed as issuances of common stock. And that is going to be identified right here, right? So we're issuing stock. And when you issue stock, you're going to get cash in from the purchaser of that stock. So now, right, hopefully that makes sense, right? It's like the opposite of repurchases. If you repurchase something, you have to spend money to take shares out of circulation. Well, if you're issuing stock, you're going to get money in from the buyer of that stock. So now we've ticked off just about everything except for retained earnings and the revolver. So let's get rid of retained earnings here now that we're here. So retained earnings, I didn't want to put it in here because really half of retained earnings half of the year-over-year change in retained earnings has already been reflected in net income. But what haven't I captured yet? What you'll typically see here is dividends, right? Payments of dividends. So payments of dividends here is going to be, we already captured it. If you simply linked to retained earnings, it wouldn't have worked. Dividends are outflows. So we don't need to change the sign. Everything is looking good. And so now I've got my cash from financing activities. And I think I've tried to be pretty careful, although one of the challenges when you're building a model is like this is a lot is going on and you got to get every line item right or the model will not balance. But I think just kind of going down the list, and this is how I like to do it. I've got every aspect of retained earnings in here. I've got everything. The only thing I have not factored in yet is the revolver. So hit the pause button right now because we're about to sort of finish this model. We've got everything laid out. The only thing left is kind of this line, and I'm gonna fill it out right here. This is now, you basically have everything done. So I'm going to actually calculate before I have you hit the pause button, the total change in cash, right? So this is a good line to sort of sum all this, total change in cash. You'll see this on companies' cash flow statements. It's kind of the sum total of all of this. Knowing these numbers are going to change in a second as we finish the revolver. But that means that at the end of the year, we're forecasting that even though the company's generating, nice cash flow from operations, they reinvest a lot, but then they're also really giving back almost all of it. I mean, really more than all of it to shareholders in the form primarily of dividends. This is a really nice way to understand what's happening in this business. Good cash flow operationally, continuing to invest in the business in a healthy way. And then, everything else, they just kind of give back to their shareholders. This is actually one of the great insights you can glean from financial statement models is just, well, what if my assumptions change? We'll get to that in a second. But right now, let's finish up this model. So I have my total change in cash. Hit the pause button, and then we're going to move on and really begin putting on the finishing touches here. All right, now we are ready to finalize this by building out the revolver. First, actually, I'm going to do one thing. And notice now that you've got the total change in cash, formulaically, you actually can now forecast cash on the balance sheet. The numbers are eventually going to change, but I can formulaically now connect the cash flow statement quite logically to the balance sheet. And I can say, okay, well, if my end of period cash, let me kind of line this up. If my end of period cash the last actual period, plus my total change in cash this year is negative 17, well, now I can forecast this, can't I? Right? I've already got the pieces to finish my cash balance. Now let's turn to the revolver. So now the revolver, we need to understand conceptually what is tricky here. And what the model needs to be doing. Really, what the model needs to be doing is recognizing that if there is a cash shortfall, this is the key to making a three-statement model. It's kind of like the final piece of making a three-statement model really work. If there is a cash shortfall, what do we need to do? So first of all, we could just hardwire this. I mean, understand that the way the model is currently set up, there is no cash shortfall. The company still has cash. Everything is copacetic. And, if we just said, look, no change in the revolver, we could just call it a day. I mean, really, we could just say, okay, well, we're not going to borrow anything and we're done. And you'll see, let's check to see if we got the model balancing. If we did everything right, and we did, it's, by the way, not easy to get it right on the first time. It means we got everything right. The model is fully in balance. What this tells me is, okay, well, under these assumptions that I've made for this business, my three-statement model is effectively done. Okay. Now, the real challenge about leaving a model like this is that it is dynamic up to a point. It's dynamic up to a point. What do I mean by that? Imagine if instead of this, I added a new case for this company. And the new case, instead of this case, was like really bad. So let me actually move this off, and let's just say that instead of this, the revenue growth being what it is, actually, you know what? I'm going to make this simpler. Let's make this 0, no growth. Let's make this margin really high. What do you think is now going to, the margin really low. What do you think is going to now happen? So now you've got losses, right? Your balance sheet is now going to show, because you're generating losses, the cash flow statement is going to look really ugly. It's going to look really ugly. You're going to generate lots of losses, and especially because you're investing more. And so in this scenario, if this were to happen, right? If your weak case was really bad, you're going to get to a point where you run out of money, and your cash balance, the way our model is set up, isn't set up to protect against that scenario. Because in reality, what would happen is no such thing as a negative cash balance. Have you ever had negative cash in your checking account? It's what you want to do is you want to make sure that in the event that things are so bad, is that you will really activate the revolving credit line. You will activate your corporate credit card to soak up, really to help you make sure this never dips below 0. In theory, when we go through our full modeling course, you actually start incorporating things like minimum cash balances and a whole bunch of other things, because you never even want it to get close to 0, let alone 0. But for our purposes here, let's just make sure this never drops below 0. Well, how do we do that? So the way we do that is we are going to have a line item in here that has to test this out. What is going on with our cash balance? So we're going to do this right here. We're going to have a line that says total cash flow before any revolver borrowing. Okay. And so we're going to calculate that. We're going to say, okay, well, if I started with this much cash, and then I've got this much cash from operations, or in this case, I'm losing it, and I've got this much cash from investing activities, and then I've got all these other outflows. This is, you have to make sure that you're capturing everything other than the revolver. Well, what is my actual cash need? I'm going to need to borrow this much, aren't I? This is the total amount of cash that I am now actually negative. And that's why you see this cash here being a negative 120. And so what you're going to want is you're going to want the total borrowing needed. Total revolver borrowing needed. And so you're going to just say, well, I just need the inverse of that, right? I just need the inverse of that. And I'm going to copy and paste this across. And then if you reflect that in here, this is just the inverse of what I need. Look at what we can do. If we define, work, by the way, isn't done. There's still a little bit more work to do to make this truly dynamic. But now I've defined it. Okay, well, this is the total borrowing I need. And so then I'm going to need to add to what the historical balance is, I'm going to need to add this amount. This is the total revolver borrowing that I need. And I'm going to paste this across, and all of a sudden now I'm at 0, right? So I've prevented this from turning negative. And on the cash flow statement, what it's done is it's because I've formulaically got this right? I'm factoring in this change. The model is grabbing all of these inflows and saying, well, these really just are a plug. It's a plug to make sure that if things are bad, I don't actually run out of cash. Well, now, the only other thing that I need to just sort of ensure is if I do bring back my operating performance, let's bring back my operating performance here to an average like I had before, average of the last couple of years, and everything is not kind of the disaster that I just made it. I want to make sure that this still works, right? Now, notice here that I need to do a little bit more work, because now what the formula is saying is, total cash is actually positive. So in the positive case, because I simply took the negative of that, I'm actually now saying, okay, well, now just pay down the revolver. I don't want to actually do this. So when there's a positive, I don't really want to have it function in the same way. Instead, I wanted to say, okay, well, if I have positive cash flows, the only thing I really want is to maybe pay down the revolver. Like if I have like any revolver balance, if I've got a corporate credit card, so the typical thing that you might want to do is say, maybe I just pay this down all the way to 0. That's a typical assumption in model. So if I have anything positive, I need to treat it a little bit differently. So how could you modify this formula to maybe fix this problem so that, it seems to work when there's a shortfall, but it seems to break down when there's a surplus? So give that a second thought, give that a thought, and then we're going to see how we do it together. This is a very common function that's used to solve this revolver problem, and you'll see it in just about any 3-statement model. Okay, so this is the final part. If you struggle with this, believe me, you're not the only one. This is a function you're going to see everywhere. Basically, what we're going to do is we're going to say, okay, look, if we have a surplus, all we really want is we want you to take the lesser of this amount. So in this case, we want you to take the lesser of this. We don't want you to take the surplus, right? If we have a positive, we only want you to work on it if it's a negative. In this case, if there's a surplus, what we want you to do is actually to simply pay down. So we wrap a min function after the minus sign. We wrap a min function and say, actually just pay down the prior revolver balance, right? And once we do that, it says, oh, actually, the smaller of 288 and the prior balance is actually just the prior balance. So let me pay that off. And now I can copy and paste this across, and all of a sudden here it gets to it and says, well, all right, well, again, I've got a surplus. Is there anything left to pay off? Nope. So I just 0. 0 is smaller than 271. Let's make sure that it works in reverse, just to make sure we didn't screw anything up. First of all, let's just eyeball that it did work here. Revolver does go down to 0. Now, the cash balance is looking exactly as it should. It's no longer a mess. Let's kind of break this down again. No profit margin, no revenue growth. Well, now we have that big negative balance. I want to make sure that now my revolver is, I have a big negative need. Now my revolver with the min function saying, well, what's smaller? This is a negative number. So this is going to trump any existing revolver balance. Okay, now I'm going to just keep borrowing. And this formula now is doing a lot of heavy lifting. And it's just growing the revolver. And it basically means that our cash balance never turns negative. This is a ubiquitous feature. It's probably the trickiest part of any 3-statement model. So spend some time with it, make sure you get how it works. But now, the magic of this, and I'm going to sort of bring back the kind of the original operating assumptions here, is you have built a fully dynamic 3-statement model. Now, it doesn't have any of the bells and whistles that we go through in a real course. You didn't have to look at a real company to go through the nuances of data gaps and things like that. But you've got a skeleton that represents the typical framework for any 3-statement model. At the end of the day, with all the noise aside, this is the core architecture that you need. Now, we have the ability, the luxury to finish everything else up. So now, we still have a few shaded lines up on the income statement. We know that we have all the debt balances that we need forecasts and all the cash balances. So really, all we need to do here is make an assumption about what is the rate on cash that we're going to earn because we have cash balances, and what is the rate on debt that we have to pay. So I'm going to add another memo here. Memo, interest earned on cash. And let's kind of make sure that we're clear that we're looking for a percentage here. And then interest expense on debt, debt, interest rate on debt. And so we're gonna, let's put this in here. The interest on cash is 3%. And let's assume the interest on debt is 8%. Again, the real numbers will be a function of, what type of company you have and what the market is looking like at any given point. So I'm gonna make sure that we got this nice and formatted with the colors that I like. There we go. And now the exercise, like all things in modeling, there's a couple of different ways to do this. We're going to do this the simple way, in a way that avoids a circular reference error in your model. I'm going to basically now take interest income, and I'm going to say, look, interest income is 3% times the beginning cash balance. If I was to sort of look at the current cash balance, the end of period cash balance, I would have a circular reference error in my model. There's certainly ways to deal with it. We talk about that through our courses. But for simplicity here, we're going to avoid it. And we are going to calculate it that way. And then for interest expense, it's simply going to be 8% times the sum. Remember, we have two tranches of debt here. Times the sum. We don't have to put a parentheses there. The sum of both debt tranches. We want to make sure, even though the revolver is 0 now, it won't always be 0. And the long-term debt. And again, I want to make sure that I actually do this and avoid a circularity. So I'm going to do this on the beginning of period balances. You lose a little bit of fidelity. Like I said, in our full course, you're going to be able to kind of go through how to avoid all of that, even with the circularity, how you manage the circularity. Here, I just don't want to deal with it at all. So now let me get the formatting right, and let's get the sign switched. All right, we are done. So this is it. So we have now completed our model. Huge. This is probably the quickest amount of time it'll ever take you to build a three-statement model. We really cut out a lot of the fluff. And now you can take a look and you see a model. This company is forecast to have net income as follows. Let's just scroll down, make sure we see how everything works. Everything should be in balance. Unless we screwed something up, that's a good sign for us. And everything looks great. So now, first of all, congratulations. Hit the pause button if you did not finish this up. Once you do wrap this up, you should actually feel really good about the fact that you built a full-scale, albeit basic, stripped down, but mechanically sound and cohesive and integrated three-statement model. Hit the pause button. Make sure that you finish that out. Now, what I want to talk about is all the things that you now can do once you've built a model this powerful. The advantage and the reason why the three-statement model is so powerful and ubiquitous is that now, and I've alluded to this already, is you can start messing with assumptions, right? Once you start messing with these assumptions, you can build cases. And in our full course, we kind of start going through what are all the different cases you can build out to really see what is the sensitivity. How sensitive is this company to fluctuation? So in our full course, we'll go through Apple and we say, well, what if Apple doesn't sell as many iPhones as it expected? How does that change everything here? You could start tweaking with different assumptions. Well, what if the company, for example, decides, we're not going to issue as many dividends or we're going to buy back more shares? This becomes the framework from which you can do a lot of analyzing. If you're operating within a company, you're trying to understand its sensitivity, you're analyzing a company for an acquisition, or you're trying to value a company, because really the natural next step after this is say, well, okay, now that I've got the forecast for this company's cash flows, well, let me build a discounted cash flow analysis based on these. Let's scroll down here to the cash flow statement. Let's actually forecast these cash flows and figure out what is the present value of this company. Is this company worth investing in? All right, really powerful framework here. I hope you enjoyed this course. It's going to be a lot more available through various lessons, various guides, various courses that we have already launched, and as well as courses we're going to be launching. If you have any questions, please shout in the comments. I hope you really liked this and found it valuable.